Hey everyone, gonna do another analysis video for the month of October. Today's the 25th. This is gonna be Halloween week, but I have some exciting analysis that I found and I want to share, so I'm making this video and very excited to share it. I'm looking here at the Nasdaq. Quick update on the major item in the Nasdaq, of course, the largest tech company here, Apple, closed this week with a bearish week candle. And if you look on all the time frames, kind of had a bad week. There is selling historically when Apple makes these highs and lows. It does it very cyclically. There we go. English is hard. Nasdaq, S&P, they all have the same look. They have this look of exhaustion. Market can go higher. I have no idea. I cannot predict the future. But if you look at Apple, Apple is not looking too good on the monthly. And it should carry or drag down the Nasdaq. Looking at the monthlies right now, Apple and the Nasdaq are above all the moving averages. Historically, that's a bad price to enter. And I'm looking to see what happens here with Apple, if it'll drag the whole market. I've been tracking the Nasdaq S&P ratio, and that also is declining. If you look historically, last time we had this market bubble in 2000, that ratio was really high, the Nasdaq to the S&P, and we are there again, same ratio. So the Nasdaq is as expensive compared to the S&P as 2000. I've shared that comment before, but we would want to see some follow through. But the exciting information that I wanted to share is the Zero Hedge article. And I was shocked when I saw this, but it makes sense that this is a chart shared in this, the mother of all stock market bubbles on Zero Hedge. And they're sharing the correlation of the GDP, the actual economy, compared to the stock market, because obviously the stock market is up quite a bit. If I go back to that chart, if we just look at the S&P, very much up, no doubt about it. Take the log off, but Nasdaq very much up. Yet GDP is down, so we have what everybody feels, which is a slowing economy. Yet the stock market is up. So this is the correlation, a negative correlating stock market. Can you believe that? The stock market doesn't care about the economy. How can that be? That's insane. It's never happened before, according to this chart, at least not prior to 1960. I guess it almost it happened a little bit in 1993. That makes sense. The savings and loan trouble that caused housing to go down, but the economy didn't really go down. If you look at the charts, it really didn't go down that much. But this was very interesting, and they have some crazy stats here. And some of the main ones are that 5 largest stocks in the S&P 500 have a combined market cap that equals that of the smallest 389 stocks. I think there's crazier stats than that. Apple, Amazon, and Microsoft and Google, just 4 companies, have a combined market cap of 6 trillion. And it's greater than the GDP of every country in the world, minus the US and China. Tesla, having surpassed Walmart, has become the 9th largest stock in the US. That's some crazy stuff. And I can't get rid of that, but The other interesting chart is this one of the past bubbles. And can you believe how bubbly we are right now? These disruptors have to be tech stocks, I would imagine. Yeah, the FANG stocks. But the last point I want to make after seeing this chart, it's really hard to predict which markets will bubble up to try to take advantage and capture them. It is very hard. You can try to catch them once they break out, like maybe in the middle, and then try to catch them. But it may not be very effective. The other way to do it is wait for them to turn around and try to capture the down move. That would be lucrative, because this if it's happening again, if this market is bubbling up and currently it's in the FANG stocks, just like it happened in 2000. Well, we know what happened in 2000. There was a huge market decline of as much as 80%, maybe even more. So the first thing to do would be to realize, hey, we're in a bubble, and then try to avoid the decline. So if we look at Nasdaq, let me get rid of these. If we look at Nasdaq on the monthly, I'm going to leave the moving averages on. But if we look at Nasdaq on the monthly, I'll put the log on, I suppose. I'll take it off. If you look at Nasdaq, it exploded and then exploded some more. Okay, so that's what a bubble looks like. It explodes and then explodes some more. So I won't go into it, but it gets parabolic. But everybody knew this was a bubble because it was so obvious, but nobody knew how high it could go, and then nobody knew when it would end. When it did end, if you just waited for it to roll over, there was a good trade there. Once it rolls over, let's say it starts making lows, it continued to do that. So let's say this was what, 37%, 35%, and it ended up going 84%. So there's still half of it left. So maybe selling call spreads would have worked. Selling call spreads or buying deep in the money puts may have worked. Okay, let's remember that. So then if you look at the current market, the current Nasdaq situation, maybe it continues, maybe it rolls over, it's hard to say. But at least currently, if it did roll over, it's hard to say where it would go, but let's just say something like where the last sell-off ended. So that right there is some percentage. Let's say from here, that's 33%, 34%, as much as 40%. So I do this all the time. I always get in too early and it's very expensive. But once it rolls over, once we know it rolls over, there will be trades there. And I'm hoping it's now, but it could, confirmation might be like 11,000, might be 10,600 on the Nasdaq. If and when it rolls over, all these moving averages will cross, and then there will be a downside trade. Okay, but if I was a buyer, I don't want to be a buyer right here. It doesn't make sense to buy above all the moving averages. It doesn't make sense to buy when the market is negatively correlated to the economy. Maybe the economy comes back, but right now, I don't think that's logical. It doesn't make logical sense. And then you see all these articles. I mean, these are all clues. Stock market bubble, economic reality. That's what we're living in right now. All that money printing to support the economy, all that stimulus. That's what that's doing. And then there's this one as well, which is the forward PE is now above the record high reached during the dot-com madness at the end of the 90s. So this is a very sharp spike, sharper than in 2000. So I don't know if this is done or if this will snap back. It's hard to say. That one took a long time. But nonetheless, we know that this valuation of forward PEs is not a good sign. We want to see these bases. We want to see these as an investor, even a trader, you have to be aware of where we stand. You have to have market awareness, and we are not in a cheap neighborhood as far as prices go. If you look at let's look at the monthly, and maybe just look at the S&P. Oops, wrong one. If you look at the S&P, does this market look cheap? Does this market look cheap? No, it doesn't. It may be hard to see right there. I can make it a little easier to see. But this is the S&P on the monthly, and using just intuition, that's what looks like cheap. When the price goes down, market's down, PEs are down, the news might be bad. Those are great buys, right? Really obvious stuff. And look where we are right now. That is, I have people that are asking me, hey, I want to increase my cash savings so I can buy a house. I want to invest in the stock market. What do you think? And I think, don't do that. It's not a good idea. Not at these prices. When the market goes up, your risk increases. When the market goes down, it's a better opportunity. The opportunity increases. From the lows to where we are now, it's over 300%. So you could argue your risk is, well, you can't really, you can say it's 300%, but that doesn't make any sense. Market can go down some percentage of that. So your risk would be the opposite of that. But I don't think it'll go down that much. The pattern has been as much as 30%. So whatever this was, 35%. Do I think that's going to happen? I don't know. Do I think this is a good time to buy? Not really. What's your upside? It would have to be a huge move up. And even that wouldn't be that profitable. If it went up to 4,000, if the Nasdaq went up to 4,000, you'd make 15%. If it goes down to the support, you'd lose 28% to 30%. That would be the bet. If you're buying here, you're betting that it goes up higher. And that would just bubble it up even more. What's up with this axis? Excuse me. So I think I'll end the video, but I couldn't believe these graphics on Zero Hedge. Hope you found them useful. If you have any questions, send them to me. Let me look at the S&P NDX. Yeah, look how cheap the S&P is when you compare it to the Nasdaq. That's how crazy expensive the Nasdaq is. Anyways, be safe, be careful. If you have any questions, let me know.